On August 15, 1971, President Richard Nixon severed the final link between the United States dollar and gold, ending the Bretton Woods system and inaugurating an era in which currency valuation became entirely discretionary. Most observers at the time interpreted this as a temporary measure, a tactical response to balance of payments pressures, and the drain on American gold reserves. What they failed to recognize was that this decision represented not an emergency fix, but a fundamental redesign of the global monetary architecture. The removal of the gold standard did not solve a problem. It eliminated a constraint, and the elimination of constraints historically has never been reversed voluntarily by those who benefit from their absence. The significance of this moment becomes clear only when placed within a longer sequence. Throughout history, monetary systems have operated within cycles of discipline and abandonment. During the Roman Empire, the denarius maintained relatively stable silver content for nearly 2 centuries under the Julio-Claudian and Flavian dynasties, but beginning in the 3rd century, as military expenditures escalated and territorial cohesion weakened, successive emperors reduced the silver content systematically. By the time of Diocletian, the denarius had been debased to a fraction of its original composition. The empire did not collapse immediately. It degraded across decades, with the currency serving as both symptom and accelerant of structural decay. The population did not riot over monetary policy. They simply adapted to progressively lower purchasing power, unaware that the erosion was not natural but engineered. A similar pattern emerged during the dissolution of the Spanish Empire in the 17th century. Spain, despite controlling the largest influx of precious metals in human history from its colonial holdings, experienced chronic fiscal crises. The crown repeatedly debased the coinage, issuing copper vellon in place of silver to finance military campaigns and service-mounting debts. By the 1680s, the monetary system had fractured so completely that different regions of Spain operated with different currencies, and the empire's ability to project power eroded in tandem with its currency's credibility. The lesson was not learned because the incentives remained unchanged. Rulers needed immediate resources, and future consequences were always someone else's burden. What connects these episodes to the present is not merely the debasement itself, but the psychology that accompanies it. Every regime that abandons monetary discipline does so with the conviction that its circumstances are unique, that modern institutions are more sophisticated, that technology or expertise will prevent the outcomes that befell earlier civilizations. This belief is not irrational, it is structural. Leaders operate within time horizons dictated by political cycles, not generational consequences. Central banks operate within mandates that prioritize employment and growth, not long-term currency stability. And financial markets operate within incentive structures that reward leverage and liquidity provision, not prudence. Since 1971, the United States has expanded its monetary base at rates unthinkable under the gold standard. The Federal Reserve's balance sheet, which hovered near $1 trillion for decades, surged past $9 trillion during the pandemic response before moderating slightly. This expansion was not confined to crisis periods. Quantitative easing became normalized policy after 2008, transforming emergency measures into standard operating procedure. The justification was always the same. Economic stabilization required intervention. Deflation posed existential risk. Asset prices needed support to prevent cascading failures. And in the short term, these interventions appeared successful. Markets recovered. Credit flowed. The system did not collapse. But beneath the surface, distortions accumulated. Asset valuations decoupled from underlying productivity. Debt levels, both sovereign and private, reached multiples of GDP that had historically preceded either default or inflationary resolution. And the purchasing power of the currency, measured not against official indices but against hard assets, began to shift noticeably. Gold, which traded near $350 per ounce in the late 1970s, crossed $5,000 in early 2025. Silver, often dismissed as a speculative sideshow, breached $100 for the first time in its history. These movements were not speculative frenzies. They were repricing events. The market was not betting on collapse. It was recalibrating expectations about what the currency could reliably store. What makes this recalibration particularly significant is the composition of the buyers. Central banks, which had been net sellers of gold for decades, reversed course in the early 2000s and have been net buyers ever since. This shift was not driven by sentiment or technical analysis. It was driven by reserve diversification imperatives. As the global financial system became increasingly multipolar, and as geopolitical tensions made dollar-denominated reserves a potential liability, central banks quietly accumulated physical metal. They did not announce this as a vote of no confidence in the dollar. They framed it as prudent risk management, but the effect was identical. Simultaneously, institutional capital began flowing into commodities not as a cyclical trade, but as a structural hedge. The emergence of stablecoins backed partially by gold reserves, the proliferation of metal-backed ETFs, and the integration of commodities into multi-asset portfolios all signaled a recognition that fiat currency risk was no longer theoretical. It was quantifiable. and it was being priced into allocation models used by sovereign wealth funds, pension systems, and family offices managing generational wealth. These entities do not move on fear. They move on probability-weighted scenarios, and the probability that fiat currencies would maintain their purchasing power over the next 2 decades had declined measurably in their assessments. The mechanism driving this shift is not complex. It is arithmetic. Governments facing large debt burdens relative to GDP have 3 options. They can raise taxes, which is politically difficult and economically contractionary. They can cut spending, which faces similar constraints and often proves impossible once entitlement programs are entrenched. Or they can inflate, allowing the nominal value of debt to remain constant while its real burden diminishes. Inflation is the path of least resistance because it distributes the cost diffusely and delays the reckoning beyond the tenure of current policymakers. It is not a conspiracy. It is an incentive structure playing out as it always has. History offers no examples of heavily indebted governments voluntarily imposing austerity when monetary expansion remains an option. The Weimar Republic, facing reparations obligations it could not meet through taxation or growth, printed currency until the mark became worthless. The result was not a single catastrophic event, but a progressive collapse in which savings evaporated, social cohesion fractured, and political extremism filled the vacuum. The French assignats during the revolutionary period followed an identical trajectory. Issued initially as bonds backed by confiscated church lands, they were printed in increasing quantities to finance war and stabilize the regime. Within 5 years, they had lost nearly all value, and France returned to a metallic standard by necessity, not choice. The contemporary situation differs in scale and sophistication, but not in structure. The United States operates as the issuer of the global reserve currency, which grants it privileges no previous empire enjoyed. It can run persistent deficits without immediate currency collapse because global trade, debt markets, and central bank reserves are denominated in dollars. This exorbitant privilege, as it was termed by French officials in the 1960s, allows the United States to export inflation and import goods at artificially favorable terms. But this privilege is not permanent. It is conditional on continued confidence in the dollar's stability and the absence of credible alternatives. That confidence is eroding measurably. The dollar index, which measures the currency against a basket of major trading partners, has declined from levels above 120 in the early 2000s to the mid-90s today. This decline has been gradual, which is precisely why it has not triggered panic. Markets do not respond to slow-moving variables, they respond to breaks. But the break, when it comes, is always preceded by a long accumulation of stress that was visible to those who cared to look. The Soviet Union did not collapse because of a single policy failure. It collapsed because decades of resource misallocation, ideological rigidity, and fiscal imbalance reached a threshold beyond which the system could no longer function. The moment of collapse appeared sudden. The causes were structural and long-standing. What makes the current environment particularly unstable is the simultaneity of pressures. Geopolitical fragmentation is accelerating, with adversarial blocs forming around competing economic systems. Energy markets remain volatile, imposing inflationary pressures that central banks cannot control through monetary policy alone. Consumer confidence, as measured by standardized surveys, has dropped to levels not seen outside of recessionary periods, signaling a disconnect between official economic indicators and lived experience. And within this context, the Federal Reserve faces an impossible mandate. It must control inflation without triggering recession, support asset prices without enabling further bubbles, and maintain credibility without subordinating policy to political pressure. These objectives are not compatible. The metals markets are reflecting this impossibility in real time. Silver's move into triple digits and gold's push beyond $5,000 are not isolated events. They are signals that large pools of capital are repositioning for a regime in which fiat currency stability can no longer be assumed. The junior mining sector, often dismissed as speculative froth, has not yet fully participated in this repricing, which suggests that the cycle is still in its early stages. When generalist capital begins rotating into commodity equities, the moves will be violent and self-reinforcing. This is not prediction, it is pattern recognition. The question is not whether the system will adjust. It will. The question is whether the adjustment will be managed or chaotic, gradual or abrupt, orderly or disorderly. History suggests that heavily financialized economies with deep political divisions and high debt burdens do not navigate these transitions smoothly. They oscillate between denial and panic, policy paralysis and overreaction, stability and crisis. The optimistic scenario involves a decade of sustained but manageable inflation, during which debts are eroded, asset prices adjust downward in real terms, and new monetary arrangements emerge through negotiation rather than collapse. The pessimistic scenario involves a loss of confidence that spreads faster than policy can respond, triggering capital flight, currency instability, and a scramble for hard assets that overwhelms market infrastructure. Both scenarios are possible. Neither is guaranteed. But only one requires the system to behave differently than it ever has before.